Hello everyone and welcome back. Today we are going to get into some core financial concepts with the time value of money. And this is one of my favorite things in finance, and I promise you that if you can get into this and really wrap your brain around it and understand it, you will become a master of finance. I will make a finance soldier out of you. So let's jump in. Time value of money is of use to financial managers and investment consultants because we're thinking about benefits and costs of investment projects, and a lot of those benefits occur far into the future. Some could be decades into the future, and so we have to figure out a way to make benefits that maybe occur in the future commensurable with costs that we would have to pay out right now. And sometimes costs occur in the future too, so we want to be able to compare future benefits and costs with present day benefits and costs in order to really get a handle and make decisions as to whether investments are worthwhile or not. And this is where the time value of money concept comes into play. The fundamental proposition here is that a dollar received today is worth more than a dollar received in the future. And we'll spend a minute or so explaining why, and then we'll think about some examples based on the idea of compound interest. So have you ever heard the saying, a bird in the hand is worth two in the bush? I found this picture of this cute little Tweety bird, but I think it really is referring to hunting for waterfowl, ducks and geese. And the idea is if you've got one right in front of you, get it, and that's worth two out in the bush that you still have to go and make the effort to hunt for. So the idea, it's better to have something right now, it's better to have something in front of you than something that's prospective. So this kind of takes us back to the idea of risk. In order to get me to give up the sure thing I have right now, you've got to give me more. And that's kind of going on with time value of money. Something I have right now, I have for sure, and something in the future is only prospective. And there's risks that occur between now and then. I'd rather have it now, and therefore there's got to be some kind of reward, some kind of incentive for me to wait, to delay my consumption. And that reward is going to be more purchasing power, growth, through interest rates or rates of return. In finance, we'd say $1 today is worth more than a given amount of dollars in the future. The dollar in the hand, the dollar we have today, can be invested and earn interest rate or rate of return, so it becomes more than $1 in the future. And so we'll say the future value, FV, of the amount of money is greater than its present value. We'll just work that statement backwards, and we could say just as well that the present value is less than the future value. Money you have now can be invested and grow, so I don't need as much money today to equal the same amount in the future. And let's kind of draw a diagram to think about that. Invested money grows over time. So I've made a time scale with now and then 5, 10, 15, 20, 25 year intervals. And what's happening to if I have an amount of money, let's just kind of draw a little stack here. Let's say I have $1,000, 1K. And what's going to happen if I invest that? Well, I'm going to earn interest on it. So in 5 years it's going to be worth more. And if I keep it invested, it's going to keep earning interest, and I'm going to earn interest on my interest, the phenomenon of compounding, and so on. Pardon my sloppy bar graph here. Okay, invested money grows over time like this. So future amounts are worth more than present amounts due to the fact that they earn interest, and that interest compounds and accrues over time. Okay, so that brings us to the future value equation. Future value of an amount is the present value, the amount I have today, times the interest rate factor 1 plus r, where r is the interest rate, to the n, where n is the number of time periods. Okay, so there's actually not a whole lot going on here. We just have r, the interest rate, n, the number of periods, and then compounding interval, that'll play into our n, whether we compound annually, semi-annually, or so on. Okay, now let me make one note here. Our textbook uses K instead of R, and heaven knows why. It's when I have a few little pet peeves. I think our book is still pretty good and it's very affordable, but I have a few pet peeves with it, and one is that they use K instead of R. But just note that these are interchangeable. Okay, so some people use K, some people use R, but they mean the same thing. Everybody uses N for the time, number of periods component. So that's our basic equation, and let's see how that plays out. We're looking at an example here where we have $200. We're going to invest it for 4 years, and it's accruing 7% interest per year. So there's all of our inputs into the calculation. So that's going to grow through just simple interest into $214 at the end of year 1. And notice here our compounding factor, future value equals present value times 1 plus r to the n. Well, the n here is 1, so it's just present value times 1 plus r, 1.07 times 200. And 7% of 100 is 7, 7% of 200 is 14, so I'm just adding this $14 of simple interest. But at the end of year 2, we're going to apply the interest rate to $214, so we're going to get a little bit more than 14 extra dollars. In fact, we're going to get almost 15 extra dollars. And then we're going to get even more than that at the end of year 3, and then even more at the end of year 4. And notice by the end of year 4, we've earned a total of $62 plus in interest. And let me just show you that we can indeed use the present value formula to work that out. The interest factor is 1.07. We're going to raise that to the 4th power, and then we're going to multiply that times our initial present value, which is 200. And there we go, 262.16, right? So that math is indeed true. Now the wonderful thing about today with the computers we have is we don't have to do this math ourselves. We have a powerful computer program to do it for us, which is Excel. And in this lecture, I'll give us a little taste of doing the problems in Excel. Then in the homework video, we're going to strictly just work present and future value problems in Excel. So we'll get really used to it, don't worry. Okay, and as I mentioned, we're talking about compound interest here. We earn interest on the initial principal and then on the interest we earn in the first, second, third period. So earning interest on your interest. So here's what that looks like. Once we get up to 20 years, and the higher the interest rate, the steeper that growth curve becomes. So 5% is not too impressive. 10% is more than double that. 15% is more than double the growth rate of 10%. 20%, it's more than double what you would get at a 15% rate. It's something like 7 times or 6 or 7 times the growth you'd get out of 10%. So if you double the rate, you more than double the growth once we get out into the future, because what's going on here is most of the interest you're earning is not on the initial amount. It's not on the principal. It's interest that's compounding on the interest that you accumulated in these intermediate years here. So give yourself enough time, and any positive rate of interest, you can accumulate as much money as you want. Okay, and that brings us to a concept called the rule of 70. The rule of 70 is just this neat little mathematical trick. It's just kind of a rule of thumb. It works for small interest rates. Once the interest rate gets pretty large, above double digits, this kind of breaks down, but it works pretty handy for small interest rates. And this tells us the years to double, for an invested amount to double at a given interest rate. So let's work some examples. 70 divided by 1%, 70 years. Now that's a long time to wait. That's a pretty low interest rate. Maybe a more realistic interest rate we could get in something like the stock market is something like 7%. And that's not an interest rate per se, but that's a rate of growth, so that it's going to work the same way. And there you see that you're going to double your invested amount in 10 years. Okay. Well, you can see that's pretty attractive, because if you have something pretty modest like only $50,000 in the stock market, but you can reliably get 7% on it per year, in 10 years you're going to have 100K, and in 20 years this amount is going to double. So it's 10 more years, this amount's going to double. Now you're going to have 200K, and then in 10 more years, another 10 years, that's 30 years out, that amount's going to double again, and then in 10 more years, so we're at 40 years out total, that amount right there is going to double, so you're going to have 800K. Well, you can see that's not far away from $1 million, right? So if you could have $50,000 invested, by age 25 or 30, you're going to have $1 million by the time you're age 65, 70. And then, of course, that's without any additional contributions. If you can kick some more money in here, kick another 5,000 per year in or something like that, which is pretty achievable for most of us, you're going to get even more growth. And I'll show you in a few minutes in Excel. We can start playing with forecasts. How much money do you want to accumulate for retirement and that kind of thing. Okay, so that's future value. We'll come back and work some more examples. Let's think about present value now. And present value is a little bit trickier, but if we just think about it in terms of what we're doing is unwinding the growth factor that we apply to calculate future value. We're backing it out, or we're undoing it, and that's what gives us present value. So let me just kind of draw this growth curve again, right? So right now, and remember what happened is our amount was growing at the rate of interest compounding over time, right? That's as we were going forward in time. That was our future value concept. We were going forward in time, future value. Future amount invested has a greater future value than its present value. Now for present value, we're just working backward in time, and we're saying this amount right here, this might be $100,000 at the given growth rate I'm working with, 7%, 5%, whatever it is. What would the equivalent amount be in present dollars? Well, that's going to be a much smaller amount, right? And what we're doing is we're undoing the growth. We're unwinding the growth to see basically what amount today would we invest at this interest rate to achieve this amount at a specified time period in the future? So to think about that, let's just remember what our future value equation was, and then I'll show you how we unwind it. Future value equals present value times 1 plus r to the n. So in this case, I'm saying we're going to wind up with 100,000. That's my future value. I'm going to solve for the present value now. And now I'm going to run with an assumption about my rate in time period. My rate, I said, was 7%. And we're still going with that assumption. That's kind of the average real return you get on the U.S. stock market for the past 130 years. So let's call that 1.07. And then my time period here was 25 to the 25th. Okay. So if I want to solve for present value, all I have to do is divide out this growth factor, 1.07 to the 25th. And that drops there, and then I get, so I'm going to rearrange this a little bit. My present value equals the future value amount, which is 100K. So I can write it down like this and actually solve it algebraically over 1.07 to the 25th. Or just generally speaking, right, this right here is my future value amount, and this right here is my growth factor, 1 plus r to the n. So generally speaking, PV is FV divided by 1 plus r to the n. Okay, now we could sit here and work this algebraically, but frankly I don't want to. I'm lazy and Excel will do it for me instantaneously. So it would be kind of fun to work that algebraically, honestly, but we don't need to. We'll spare ourselves some time. What I do want to show you, though, is the relationship here. So future value we get by multiplying our current amount by the growth factor. That's what tells us the growth going into the future. Taking that growth out, coming backwards, unwinding it. Well, how do we undo multiplication? We divide. So now we divide the future amount by the growth factor, and that's what gives us the present value. So future value is a function of multiplying. You multiply by your growth factor. Present value undoes that multiplication problem, and so we talk about dividing by the growth factor. Okay, so there's just a more clean repetition of that formula. Recommend writing all this stuff down. Now we won't have to use the formulas per se, but we want to be familiar with how they work. We'll have Excel do the math for us. Here's the same concept with that $200 looking into the future. And now instead of finding the future value, we're finding the present value. So at the end of year one, if we discounted, and this is the term we use to find present values, we're discounting the $200 by the interest rate growth factor, we'd find that it would only take $186.92 invested at this amount to achieve the $200 in 1 year. And that's a good way of thinking about present value. What amount would it take to reach this target amount of money at this interest rate in this time frame? And the farther we go out into the future, you notice we're going to be dividing by a bigger growth factor or unwinding a bigger growth factor, so the present value will get smaller and smaller and smaller. In fact, we could say, if you give me a long enough time horizon, I've said I could get you $1 million. I could start with $1 if I wanted to. Give me hundreds of years. $1 is going to grow to $1 million at any positive interest rate. All right, so the longer the time frame, the smaller the present value is. That's the principle there. And as I mentioned, that's called discounting. Here's a chart that shows the discount effect of higher interest rates. The present value of $1, it gets closer and closer to zero the higher the interest rate gets, and the longer into the time into the future we get. So at 20 years, at 20%, we're asymptotic to zero, which means we're getting vanishingly close to zero. We'll never quite get to zero, but we get very, very close. At 5%, the present value of $1 is in 20 years is less than 50 cents. Okay. A few years out, you see the discount factor is not as big. Farther in time we go, the bigger the discount factor gets. The higher the interest rate, the bigger the discount factor gets. Just like with future value, the farther in time we go, the larger the growth is. The higher the interest rate, the larger the growth is. So these things complement each other. One undoes the other, if you will. Okay, so compounding and discounting, this chart here just kind of shows how they're related. Here we're assuming our payment is $1,000 or our cash flow is $1,000 per year for 5 years. And compounding takes the value of that initial amount at its interest rate plus the value of the second amount times its interest rate and the interest we got on the interest of the first payment, so on and so on. Okay, and that gives us our future value. Unwinding that, taking the present value, discounting, dividing out the growth factor of the first and then the second and the third, fourth, fifth, and then adding those up gives us our present value. So whether we're talking about a single amount, a lump sum, or a stream of payments, the principle is the same. The process is basically the same, just a little bit more in the calculation. All right, so let's work with an example with some real numbers here. We've got an ordinary annuity lasting 5 years at 5.5% interest. And what that means is it pays equal payments at the end of each year of $1,000. So the first payment occurring at the end of the first year is worth $1,238 at the end of the fifth year. The second payment of $1,000 is worth about $1,174. Third payment $1,113. The fourth $1,055. And what's that fifth payment going to be that occurs at the maturity of the annuity? Well, there's no growth in that because that's at the very end. That's when the annuity stops, so it's only $1,000. So we add all those up, and that's the value, the future value of the annuity, $5,580. It's not just $5,000 because the amounts we got in the earlier periods of the annuity are going to earn and compound interest at the stated rate. Okay, now one more thing to consider when we're talking about cash flow streams and finding their present value is perpetuities. Perpetuities are cash flow streams that continue forever. Now, where would you find perpetuities? There actually are certain kinds of bonds called consols. And the British government has issued consols. The consols pay you interest forever, well, at least until one of two things happens. Either Britain ceases to be a nation state, or the Lord Jesus Christ comes again and ushers in a new heavens and a new earth. If either of those things happen, we probably have either bigger worries or actually something to celebrate. So we're not going to have to worry about losing out on the interest on our consols. But nonetheless, there are such investments. And the fact that a really long-lived asset, the discount factors from the payments you get far into the future kind of approach zero when we take the present value, they don't matter that much. So when you're talking about really long-lived assets, when we do present value on them, it's going to approach, or it's going to become pretty approximately equal to the present value of a perpetuity. So sometimes it's useful to use the perpetuity formula if you're talking about assets that last, into the decades or centuries. And I'll give you some examples of that in the homework as well. Here's the formula for that. It's the sum of the discounted value, basically, of every cash flow. So we discount each cash flow and then add them all up. So here's an example again with the 5-year annuity at 5.5% interest. Now we're taking the present value. So we discount the $1,000. Remember, we're saying what amount invested today at this interest rate would equal $1,000 in 1 year. The second 1,000 is worth $898 today. The third 1,000 we're discounting out for 3 years. Notice the discount factor gets bigger and bigger because the exponent, the n on it, present value equals future value divided by 1 plus r to the n. The 1 plus r component's the same, the future value is the same, but this n is changing and it's going up. And as that goes up, the denominator of the equation goes up. And if the denominator of the equation goes up, the value of the whole equation goes down. And that's why, as we go farther and farther out into the future, present values get smaller and smaller and smaller. And as I mentioned, far enough out into the future, 100 years into the future, that present value is going to get vanishingly small. So the formula for present value of annuities will converge to present value of perpetuities. Okay, and here's how we're going to work out the perpetuity. Constant stream of cash flows that continues forever. Present value is the payment, the annual payment, times the sum, and it's an infinite sum of 1 over 1 plus r to the t. So we're basically adding an infinite stream of sums up. Well, that's going to reduce, and I don't know how to prove that. It's a little bit above my head, but we can just rely on the fact that it reduces to this, the payment times 1 over r, which simplifies to payment over r. So you think about, it's really easy to do this in your head even sometimes. If the payment's $100 a year and the interest rate is 5%, what's that bad boy going to be worth? That's the present value. This is 0.05. 100 divided by 5 is 20. I need to add 2 decimal places. That's worth $2,000. Why does that make sense? Because 100 is 5% of 2,000, and it's going to pay 5% every year. Well, I'd be willing to pay up to $2,000 for that, because if I paid a penny less than $2,000, I'd be making some net money on that deal. Okay, I'm not going to pay a penny more than $2,000, and if I paid anything less than $2,000, it'd be free, profit for me. It'd be arbitrage. So that's how we value things that have a payment that lasts forever. And you're thinking, well, other than the Consul, that mythical British Consul bond, what has payments that last forever? Well, land has payments that last a long period of time. There is some maintenance involved and upkeep, but land can keep producing for a long, long time. Certain types of properties and improvements on land can keep producing for a long time. There are bonds that last 100 years. U.S. companies have actually issued what are known as century bonds, and so the value of them is going to approach pretty closely the perpetuity value. So the perpetuity formula is really worthwhile, and it'll come up again. We'll be doing some practice problems using this one as well. I promised I'd show us a few things in Excel, so let's jump over here and just kind of get our feet wet, and then on the homework we'll do a lot more of this. The way Excel works, whether we're doing future value or present value, the sequence of arguments in the function is always the same. Rate, inper, payment, PV, type. Well, of course, PV would be FV in a present value problem. It's going to be PV in a future value problem. But this structure is always the same. So the way I like to do things in Excel is just enter those values in cells and then enter the function in the cell below, the highlighted cell here, using each of these cells as a cell reference for the arguments of the function. So what am I talking about here? Well, let me show you. Let's talk about saving for retirement. And I've told you to expect about a 7% return on a broad stock market portfolio over a long period of time. Of course, there's a lot of risk in that fluctuates. It can be negative, it can be a lot larger, but on average you're going to get something about 7%. And let's say you're a young person just graduating from college, just entering the workforce, so you might have 40 or more years to accumulate money in your retirement investment portfolio. How much can you put in there every year? Now we're talking about an annuity. Well, let's say you work for 50 weeks of the year, and each week you can put just $50. Okay, not that much money, $2,500 a year. And I'll go ahead and format that as money. I'll go ahead and format that as percent. Okay, there's no present value. Now, if you did have a lump sum, if you inherited $10,000 from your uncle, and you were going to start with that and then add the $2,500 a year, you could go ahead and put that in here. But let's just say you don't start with anything, so we'll keep that 0. Type refers to whether your payments occur at the beginning or end of the period. If you leave it blank, it's the same as putting in a 0, which means the payment occurs at the end of the period. If you put it 1, that makes a payment occur at the beginning of the period. Now, with this problem, does a payment occur at the beginning or end of the period? It's actually a little bit of a mix, because I said you're putting $50 per week in, so your payment actually occurs spread over the time period. But it's probably safe just to go with the 0, the end of year assumption. That, if anything, it's going to underestimate our growth a little bit. So you'll be pleasantly surprised that you actually have a little bit more than this much money when you reach age 65 and you want to start spending your retirement fund. Okay, so let's do the math. The function in Excel for future value is equals FV. And then there's a list of the arguments, as I mentioned, rate, comma, inper, comma, payment, PV, type. And to enter the arguments now, we just go ahead and select these cells in this order. C2, C3, C4. Now I could actually just stop here because there's no arguments for my PV and FV, but I'll just go ahead and plug these in. If I plug them in as 0, it's not going to affect anything. So I've got all my arguments, and bada bing, bada boom. There's my future value at $499,000. Now you might ask, why is it showing that as a negative? Excel wants to treat payments as a outflow, so if I put a negative sign on that, that'll flip this around and make my future value positive. And that is, in accounting sense, more realistic because the payments are going out from my bank account into my investment account. Okay, but that's just kind of a little quirk of Excel. If you know that future value should be positive, either just change the sign or go up here and change the sign of the payment. I could just as equally have gone ahead and done the negative future value by adding a minus sign in front of that. One thing I really like about Excel is I can keep that there. I can just copy it and paste it over here, and then maybe just change 1 or 2 assumptions. Let's say I do start off with a $10,000 inheritance from my uncle. Well, you can see that increases my future value by a lot more than $10,000 because we're going to be compounding growth on top of that from the very beginning for a 40-year time period, right? What if I double my contributions? What if I don't have the inheritance and I double my contributions? I'm going to double the amount of my portfolio, okay? And that makes sense because I'm doubling the contribution in each period, so I'm going to get double the compounding impact every time period. What if I think I can get a better rate of return? And let's go back to the initial investment amount. Okay, so I can really just change those assumptions really easily because everything's done by cell reference, and I can play out a lot of different scenarios, and that's really the beauty of Excel. So I can do scenario A, scenario B, scenario D, and so on, and save them all, have them all there, compare them side by side, and that's a really beneficial feature of Excel. And as I mentioned, we'll be doing a lot more practice and homework problems in Excel. So if this all seems intimidating, don't worry. We'll be doing a lot of it. You'll be used to it pretty soon. Let's just close and working some present value problems. Let's say that we have a investment opportunity that pays $1,000 per year for 10 years, and I want to use my 7% rate of interest to discount those payments. At the end of the period, let's say it has no residual value. If it did have residual value, I could plug that in here. And the type, we'll again go with that 0 assumption. Okay, now how does PV work? Well, we just do equals PV, same sequence of arguments. The rate is there in G2, my number of periods is there in G3, my payments there in G4, my FV is there in G5, and my type is there in G6. So the calculation's telling me that at this rate of interest, this stream of payments lasting for 10 years would be worth $7,000 today. And again, if I want to make that present value positive, I just either change the sign on my payment or change the sign here on the present value. Okay. And then we could adjust our assumptions. Well, what if it actually lasts for 15 years? What's going to happen to the present value? It's going to go up, right? What if the discount rate is lower? Present value is going to go up. What if the discount rate is higher? Present value is going to go down. What if there's some residual future value? What if the investment's worth $10,000 at the end of the period? We're discounting a greater amount, and so the present value goes down. Okay, so we can just plug in things. We could duplicate this and run a whole lot of different scenarios and really get the feel for what's going on when any of these factors changes. And it's just so easy, and you can visualize it, and that's why I'm a huge advocate of using Excel to do this. And by the way, businesses that are involved in any kind of financial decision making, which is going to be pretty much any business, they're going to be using Excel as one of the primary tools for doing these kind of calculations and making these kind of decisions. So it's a really good idea for all of you to go ahead and get really familiar and comfortable and qualified in the use of Excel to do this kind of work. And that's exactly what we'll be doing from now on in the class, and we'll follow up with this in the homework tutorial video, which is coming up next. See you then.